hedge accounting? There are very few topics, I would say 2-3 terminologies that we need to understand about hedge accounting under IFRS 9. Actually, why hedging is done? What is hedge? Sometimes, whenever we are, I would say, uncertain about upcoming inflows and outflows, whenever there is a liability, you want it to be at the minimum. You do not want it to increase. Okay. And if it's an inflow, you do not want it to decrease. Instead, you want at par or higher amount. So whenever there is a future inflow or outflow, okay, whenever there is a future inflow or outflow in the transaction, and if entity is uncertain about the inflows and outflows, if entity does not want to take risk, if entity wants to decrease their risk, then in that case, entity enters into hedge accounting. Very simple one. I'll try to take an example. For example, there is entity A. For example, they have exported. For example, they have exported goods and will receive 1 lakh dollars 3 months later. Okay. Now, entity, for example, the current rate is $1 equals to 80 rupees. Now, the company is expecting to receive 80 lakh rupees after 3 months. But as you know, the markets are very fluctuating. They do not want to, I would say, bear any losses. So maybe entity hears a news that, okay, there might be fall in the price, fall in the exchange price, and thereby they are expecting that $1, expecting that after 3 months, the exchange rate might be $1 equals to, for example, 70 rupees. Definitely, it is foreign exchange currency, and there will be a loss, because instead of receiving 80 lakhs, the company, the entity A, will receive 70 lakhs. Do you agree? Good. So there is a risk of fall in receivable. Okay. Or you can say final receipt, final inflow. There is a risk of fall in final inflow. And thereby, in order to reduce that risk, they can enter into a contract. Enter into a contract. This entering into a contract, this entering into the contract is known as hedging. Entering into a contract is known as hedging. Hedge means to mitigate risk, they have entered into another contract. Now, what can be possible? They can say that, okay, they can go into the market and entity A can say that, Mr. X, any market participant, that please, I want to make a contract with you that 3 months later, I will come and sell $1 lakh to you. Okay. And provide me, okay. And they have already fixed the rate. For example, at the rate $1 equals to, they can agree on any price. They can agree on 80 price, 81, 82, 79, 77, any price. It can be lesser, it can be more. It depends whether the person will charge any premium, fees, etc. So for example, they say that I am ready, I am willing to sell you at $79. Sorry, rupees. Give me a quick thumbs up. Do you get this? Now, in case after 3 months, if prices fall to 70 rupees, then entity A will receive $1 lakh. They will not sell it into the market. Instead, the entity A will go to Mr. X and say that Mr. X, please take this deal. I've received $1 lakh. Please, I want to sell this $1 lakh. Please give me 79 rupees for each dollar. Okay, so this is how hedging is done. Hedging is just another contract entered into in order to make sure that future risk is reduced, future uncertainties are under control. If there are receivables, then our receivables are maintained, or you receive a little higher amount, the risk is lesser, the receivables will not flow. Whereas if it's a liability, you want to reduce it as much as possible. On the other hand, if okay, similar case, if you are planning that okay, you might be you on after 3 months you will be required to pay $1 lakh, and right now the rate is $80, you are expecting that the exchange rate will become $85. Therefore, instead of paying 80 lakhs, you will be required to pay 85 lakhs. So there is 5 lakh higher inflow. In order to make sure that you reduce this liability as much as possible, you can enter into a reverse contract. Okay, let's read this. IFRS 9, that is Financial Instrument Standard, permits hedge accounting, where there is a designated hedging relationship between a hedging instrument and a hedged item. Okay, we will read the definition of hedging instrument and hedged item. So whenever there is a very, I would say, identifiable established relationship between hedging instrument and hedging item, we will say that IFRS 9 permits hedge accounting, and we can go ahead and record it. Hedge accounting is therefore optional. Very importantly, it is company's choice whether they want to enter into any extra contract, yes or no. It is entirely optional. Okay, it is company's choice whether they want to, I would say, mitigate their risk, upcoming risk, whether they want to take insurance policy or not. Okay, this is like your life insurance policy. Now it is your, I would say, choice whether you want to take risk cover, yes or no. Similarly, here also, it is up to entity whether they want to opt for this hedge accounting or not, whether they want to enter into hedge contract or not, or does not have to be applied. It is not compulsory. Give me a quick thumbs up. Not compulsory. It simply reduces exposure to risk and uncertainties. It simply reduces exposure to upcoming risk and uncertainties, allows losses on a hedged item to be offset against gains on a hedging instrument. Okay, just to be clear, for example, you will receive $1 lakh from your customer. Let's say this, okay, this contract has a number, and for example, this is contract number, item number, contract number. For example, this is A11. Just an example. And for example, the entity has entered into another contract with another market participant. And for example, this contract again, that we will sell $1 lakh at $1 equals to 79 rupees. For example, this is contract number, item number A12. Very importantly, Just a quick pointer that this A11 will be known as hedged item. The item, the contract for which we have done hedging, the item which for which we want to cover losses, are known as hedged item. Whereas the extra contract that we have entered into in order to make sure that the risk and exposures and losses are mitigated, or I would say settled off, are known as hedging instrument. This is Swati Gupta, Chartered Accountant.